appear on my balance sheet for 261, and if I was doing a group balance sheet, this number would be my additional expense in retained earnings. If you like journal entries, then the process of recording the additional expense is a debit to P&L, a debit to wages, a debit to expenses of 141,333, and is a credit to equity, is a credit to my other components of equity, which is 141,333. The value of options is based on the grant date. You continue to expense the value on the grant date, even if that value rises or falls. You base it on the value at the grant date. Yeah? If you reprice them, you're giving them an extra item there. This, of course, is a non-cash expense. This, of course, is a non-cash expense. Now, this afternoon, we're going to do cash flow. And we always have a reconciliation at the beginning of our cash flow. And at the beginning of our cash flow, when we do a reconciliation, we add back depreciation. Why do we do that? It's a non-cash expense. So depreciation is a non-cash expense. Share-based payments are a non-cash expense. So that would be something that you would add back in a cash flow statement as a non-cash item. That's a very quick look at some of the writing and some of the application to do with share-based payments. Equity settled, share-based payments. There are some other issues knocking around. There are some other questions knocking around for you to have a look at. I hope you understand deferred tax, but I know some of you haven't had a great deal of opportunity to revise it. Let me just spend a few minutes making sure that, understand it or not, you can do some mechanics, you can go through some motions, you can pick up some marks. But at the same time, I hope that what I'm about to say will help you with your understanding of deferred tax as well. Deferred tax is provided for on all of your year-end temporary differences. Now, strictly speaking, there are two types of temporary differences. Sometimes we call them taxable. Now, if they're taxable, I think basically you've got a gain and you're going to have to pay tax. So there's quite a strong correlation here between a gain that is taxable and you have a liability. So when we talk about a girl, a lady, a woman, a female, she, there's a consistency of language that you're talking about things which are taxable, their gains, and they're taxable, and their liabilities. And if we're talking about boys and men, and he and masculine, there's a consistency of language. And so the opposite is where the temporary differences are deductible temporary differences, and deductible temporary differences tend to revolve around accounting losses, and they create a deferred tax asset. We provide for deferred tax in full on all year-end temporary differences between the carrying value of assets and liabilities and their corresponding tax base. So we provide for a deferred tax in full on all year-end temporary differences between the carrying value of assets and liabilities and their corresponding tax base. One exception, goodwill. Don't ever get involved in deferred tax on goodwill. Yeah, it's only in the group accounts, and it is an exception to the rule that we provide for deferred tax. So deferred tax is provided for in full on all of your year-end temporary differences between the carrying value of assets and liabilities and their corresponding tax base. Carrying value means IFRS. Carrying value means balance sheet. Carrying value means you've applied your technical accounting standards to come up with the asset after the impairment review. Yeah? To come up with the liability that you've provided for. You've accounted for something under an accounting standard to give you a figure in the accounts. Tax base is weird. Tax base is looking at things through the eyes of the tax authorities. So your basic steps are: determine the carrying value, per IFRS, determine the tax base, i.e. the amount acknowledged for taxation purposes, and therefore you have your temporary difference. And then you have to toss a coin. Is it taxable or is it deductible? If the carrying value of your asset is greater than the tax base of the asset, then it's taxable. But if the carrying value has suffered a loss and a write-down, then it's deductible. So, I don't know, these are childish things that you can rote learn. Maybe, hopefully you understand it, but it's also possible to effectively rote learn when it's taxable and when it's deductible. If you've got the carrying value of a liability, and the carrying value of a liability exceeds the tax base of the liability, then it is going to be deductible. And so, presumably you could have a carrying value of a liability that is taxable, but I'm not aware of any examples. So I know it would be symmetrical for me to add something in here. But if the carrying value of the liability exists, often the tax base is nil, and that means you've got a loss, you've got an expense. I suppose I will put it in. I will put it in. But if the carrying value of the liability is less than the tax base of the liability, then you've got something which, yeah, is giving you a deductible temporary difference. When you calculate, if you calculate it, we use the tax rate, and we use the tax rate at which we would expect to pay the tax, and there is no discounting. So we are prohibited from discounting deferred tax liabilities. So if you are given two different tax rates, 20%, 25%, the tax rate that you use is the tax rate at which you expect to pay the liability. Now, in the vast majority of questions, you're just given one tax rate. The tax rate is 20%, so you use 20%. You take your temporary difference, multiply it by 20%, and there's your deferred tax liability or assets. But in theory, if you're given two different rates, today's rate and tomorrow's rate, use tomorrow's rate. Because you are going to pay tax in the future, and if you know what the future rate is going to be, then you would use that future tax rate. No discounting, because you don't know exactly when you're going to pay the tax, so you cannot discount. That normally takes me about an hour. But I'm just going to say it all again. The net result is we end up with a deferred tax liability or a deferred tax asset. I mean, you're able to offset the two if you're allowed to do that if it's in the same country. But your deferred tax liability is because you've got a gain. So when you revalue the asset up, the carrying value goes up, there's no current tax assessed, tax base remains the same, you've got an accounting gain, so there's a deferred tax liability on that gain. If there's an impairment loss, the carrying value of the asset comes down because you write the asset down. No tax relief is given on losses, they're notional, they're non-cash. Tax base therefore remains the same, it ignores the loss. This therefore creates a deductible temporary difference because you've got a loss, so you have a deferred tax asset. You provide for deferred tax in full, you provide for deferred tax in full. The process, the procedure is that you would determine the carrying value, then you would try and determine the tax base, and because you've got a carrying value and a tax base, that's going to give you a temporary difference. Then you've got to flip a coin, which way round is it, what's happening, and then you do a small computation. Clearly, it's possible that you could be asked to write this out, explaining how deferred tax works, but realistically, it's part of an application, so it's part of a scenario. Let's have a look at an exercise. Let's have a look at a question. Just before lunch, I will get you to have a look at something. I do want you to have a little go at something. I will review it. It's one example. There's a limit to what we can do here in terms of time. So let's have a look at the question of Ronaldo. This is a question on page 104. And effectively, let's have a look at the last paragraph. Let's have a look at the last paragraph. So page 104.